All right. Good morning, everyone. Welcome in. We're so happy that you would join us today. Today is Tuesday, October 10th, and this is our Capstone Coffee Conversation. I am your host, Brian Felshaw, today. We've got Dustin here for the first time, manning the computer behind the scenes. So we're excited to be here with you today. We're going to talk a little bit about bonds today. And I'm excited for this because for the first time in probably the greater part of a decade, really, bonds are extremely relevant and extremely important to most of your portfolios that I see in here. Every single one of you can benefit from understanding a little bit more about bonds as interest rates have risen and suddenly they provide an investment opportunity that they haven't provided very often in really the last 20 years. So we're going to talk a little bit about the state of interest rates right now. We're going to talk a little bit about bond physics, how they work, and we're going to talk a little bit about what are we doing about it? How are we investing money as a result of the things that we know about bonds and have seen played out in the last 18 to 24 months, really, at this point. So let's start there. We have talked about interest rates in the past. We've talked about what's called an inverted yield curve, or interest rates on the short end of the curve are higher than the longer end. And we'll look at that in a minute. We've talked about recessions. We've talked about how fast interest rates have gone up. And we've talked about all these things with you in individual meetings, but it's always good to do a little check-in on where are they as of today. So Dustin, why don't you go ahead and share the screen? And we have an image here of bond interest rates for various different maturities. So 1 year, 3 year, 10 year, all the way up to 30 year for US Treasury bonds. And there's a couple different lines on this screen. The ones I want to highlight for you are December 31st, 2021's line, where we see interest rates were very low at that point. For example, a 1 year Treasury bond got you maybe 0.5%, if not a little bit less. But fast forward to September 30th, just recently, we have interest rates north of 5 in some cases, and the 10 year close to 5 at about 4.8. This is a big move in the last 18 months, and this has absolutely an effect on investment implications. So just a reminder, the Federal Reserve, we've been talking a lot about the Federal Reserve the last year or so. As they raise interest rates, they mostly influence the front end, meaning the short-term bonds, the 1 years, the 6 months, 2 years. Those are influenced by the Federal Reserve. The longer end, so think 10 years and above, that is more influenced by just the market. Who wants to buy those bonds? The more people want to buy those bonds, the lower the interest rate that they're going to get issued at. The less people that want to buy those bonds, the higher that rate's going to go because they're trying to entice more people to buy those bonds. So they're offering higher interest rates until enough people raise their hands and say they want to buy them. And then maybe the rate comes back down a little bit. So just a reminder, far side, the longer terms, those are influenced by the market, the bond market. The shorter side, the shorter term, a lot more influenced by the Federal Reserve moving interest rates. So that's a little bit about where we are right now. Now, why is this important? Well, in order to understand why this is important, we need to talk about how bonds work, a little bit of bond physics. So let's go ahead and talk about that. We have talked about the bond teeter-totter before, and we've talked about this with a lot of individual meetings with you. What happens with the teeter-totter? When one end goes up, the other end comes down, and vice versa. It works back and forth. When it comes to bonds, on one end of the teeter-totter, you have interest rates, and on the other end of the teeter-totter, you have the value of the bond or the principal, whatever you've put into the bond. As interest rates rise, that influences the value of the bond to come down. And vice versa, as interest rates come down, bond values tend to go up. The reason for that is because of just how big the bond market is. The bond market is actually bigger than the stock market. There's constantly new bonds being issued by governments and corporations and small businesses. They're trying to raise money by getting loans, right? That's what a bond is. It's a loan. You're investing in a loan. So what happens here is if I buy a bond when interest rates are down here at 1% for let's say a 1-year government treasury bond, if 6 months later they issue a new bond, now at 3%, well, my 1% bond doesn't look very attractive if anybody else wants to come in it. So the value has to come down. So that's how that teeter-totter works. That was bond 101 class. Now we're going to move to bond 305 class. To drive this home, I have an analogy for you. I have a 3.5-year-old son named Logan, and he loves Lions Park down in Bremerton. It's right on the water. It's a beautiful park, lots of space to run around. But one of his favorite things there is there's a massive teeter-totter. And he loves to get on the teeter-totter with me because I can sit on one end and just launch him up into the sky. He's a little bit of a daredevil. But the reason I can do that, one of the reasons I can do that is because it's a very, very big teeter-totter. It's very long. And so the leverage is a lot bigger than smaller teeter-totters. So here's how that applies to bonds. The longer the term of the bond, the more you're going to see that swing in its value when interest rates move. So for a 1-year or a 6-month treasury bond, that teeter-totter is very, very small, and you're not going to see much movement or effect when interest rates move. But a 10-year bond or a 30-year bond, you're going to see a lot bigger swings in value when interest rates move because the teeter-totter is bigger. Let me give you some real-world data about how that works. So this is from JP Morgan. As of right now, where interest rates are right now for bonds, remember that curve that we just looked at. If we see a 1% move down in rates for a 2-year treasury, that would equate to a total return on average of about 7%. So the interest plus the movement and the value of the bond. This is if we get a 1% move up in bond rates. Not a big move. We're just talking about 1%. 12 months later, 7% total return. A 5-year treasury bond, 9% total return on average 1 year later from that 1% move up. 10-year treasury, 12.5% total return. High quality corporate bonds, so think of like Microsoft and Apple bonds, 12.8% total return after a 1% move down in rates. 30-year treasury, so about as big of a teeter-totter as you could get, 20.9% total return after rates come down 1%. So the bigger the teeter-totter, the longer the term of the bond, the more effect that's going to have. Now, what about a 1% move up in rates? If rates move up, remember the bond value comes down. 2 and the 5-year treasuries, not going to be affected as much at this point because the teeter-totter is smaller. But the 10-year treasury, if we get a 1% move up instead of down in rates, then there's about a 3.5% downside for that. High quality corporate bonds, call it 1% downside. 30-year treasury, about 11% downside. So that 30-year treasury, you've got a 20% upside if bonds go down a little. If bonds go up a little bit, it could be down 11. So much more sensitive for the longer term 30-year treasury. Why are we talking about this? Because we feel, and a lot of people feel, that we are at least close to the top of the interest rate hiking cycle from the Federal Reserve. We have been talking about this for a while, and the Federal Reserve has emphasized that they're going to be dependent on what data comes out. They're going to make their decisions based on if they think the economy is reflecting properly the interest rate hikes that they've already accomplished, namely an inflation. Where is inflation? If inflation's coming down to their satisfaction, then they may be done raising interest rates. If it hasn't, They may not be done. They may want to raise some more. Just yesterday, the chairman of the Federal Reserve, Jerome Powell, came out, and this was mostly in response to what's going on over in the Middle East at the moment, in Jerusalem and Israel. He recognized that interest rates have moved and possibly moved enough to be adequately restrictive to keep inflation in check. Now, that could change. If inflation spikes again, he may reverse his statement, but that was his latest statement. These signals are telling us that there's a likelihood that we're towards the top of this interest rate cycle, meaning the rates are up here, the bond values are down here, and eventually that's going to reverse, and it's an opportunity for bonds. So when we think about this, we often play this game, what's more likely, right? How do we make decisions based on what our clients' goals are? How do we allocate money to make sure we're getting the most bang for the buck? When it comes to stocks, we're trying to look for opportunities. We're trying to look for who is at a good value. The same is true of bonds. A lot of us know by now and are intuitive to know that the right time to buy stocks is after they've come down. The more they come down, the more attractive Costco and Microsoft and Walmart, these big companies become. The more they come down, the better buy they are. Well, bonds, we have to look at that the same way. Whenever rates are this high, it presents an opportunity to be able to allocate money towards bonds, because at some point, maybe longer than we all think, but at some point, those rates will come down and we could get a bump in the value of those bonds. That's why this needs your attention, especially if you're in the retiree bracket and you're looking for a degree of safety. That presents an opportunity to you. Another point on this is we are at a multi-decade high for rates. So as we look back in the last 20 years, there's only been 2 times that interest rates have been this high, 2007 and the year 2000. Those 2 points, we had interest rates as high as they are now, and bonds had great returns going forward the years after those points, because eventually rates came down. So we're looking at the Federal Reserve, we're looking at history, and we're looking at the fact that at some point rates could come down. That equates to an opportunity, and why we're talking about this today. So let's talk about what we're doing about it, what we're doing in your portfolios, and the conversations we're having with you about actually how do we invest money. Throughout 2023, throughout this year, we've been slowly dipping our toes out further and further into longer and longer bond maturities. So for example, many people have had short-term bonds. We've kind of focused on that side because it's been paying the most interest and rates were rising. So we want a smaller teeter-totter. As that has changed this year, we've started to dip our toes out there and start to buy some longer-term bonds. I would say on average between everyone, it's about a 4 to 5 year average maturity. Instead of a 1 year like we've been, dipped our toes out into the 4 to 5 year. There may come a time where we want to be longer into the 10 year and into the 15, 30 year. Maybe that will come, but there's still some uncertainty on how high rates could go. So we're just starting to dollar cost average into those areas. Dollar cost average meaning just dripping a little bit each month so that we get an average good price. Like you would dollar cost average into stocks, you buy a little bit each month rather than picking just one day and hoping it's a good price. We're doing the same thing with bonds. Going forward, because of all the things that we've talked about, comparing bonds to stocks, there's not much downside to bonds at this point. We saw with some of those historical figures that we read about, there's a much bigger upside at this point to bonds than there could be a downside, because the likelihood is that rates may be close to their top. Whereas stocks, we look at the economic backdrop, there are some recessionary signals. Not everything, it could be just fine. It could be much more rosy than we think, but that would weigh on stocks, whereas the bonds would probably hold their value just fine during that time. So the attractiveness of bonds to stocks, let's say I'm a 50-50 kind of portfolio, I may have a little bit more towards the bond side. I might be 55 or 60% bonds instead of half and half. On top of that, I want to touch on the kinds of bonds that we're buying. So we tend to focus on the higher quality bonds. And what I mean by that is the likelihood that they're going to keep their interest payments going. In the world of bonds, all bond issuers, so governments, businesses, whatever kind of entities, they all have a credit score. AAA, AA, single A, triple B, kind of like you and I do have a credit score. That tells us how healthy is the company and how likely are they to pay back those bonds. We tend to stay above what's called investment grade, meaning they're likely to pay it back. So think big businesses, safe governments, as opposed to startup companies or very unstable government bonds. We wouldn't buy those. There may come a time for those, but we concentrate right now on the higher quality bonds. So dipping our toes out into the future a little bit, but staying on the investment grade, higher quality side. On the same note, one of the things that we love about bonds is they are liquid. We can sell them to somebody else at a moment's notice if we decide. We're not tied in for all 10 years of the 10-year treasury bond. That's a common misconception. That's a publicly traded bond that you're owning. And if you own it the whole time, you're going to get all the interest. But if you decide there's an opportunity over here that we need to go to, you can sell that bond, someone else will buy it and pick up the remaining interest, and you can move on to something else. Or if you need money for an IRA distribution or anything like that, they're 100% liquid, as opposed to something like a CD. CD rates out there right now are higher than they've been, just like other bonds. But when I think about a 12-month CD, I'm giving my money to the bank and I'm locking it up there. I can't touch it without an early redemption penalty. What's going to happen in 12 months? Maybe rates will be lower and I'm going to get my money out of the CD. And now what can I reinvest it in? Who knows at that point? Maybe rates are higher. Maybe rates are higher and it's going to be better, but maybe rates are lower. And now I have to find something else to invest that in. That's called reinvestment risk. So whenever you have an illiquid instrument like a CD, it makes it harder to determine what am I going to do when that matures, because you're locked in, versus a treasury bond or a corporate bond. We can sell them at any time, or we can buy a longer term, or we can decide anything we want to do. Let's go ahead and pause there. Just to recap, we talked about where interest rates are right now. We talked about bond physics, the teeter-totter, and the bigger the teeter-totter, the more sensitive for good and for bad the bond values are to interest rate movements. And then we talked about how we're starting to slowly dollar cost average into a little bit longer term bonds. And we're also focusing on very liquid bonds and high quality bonds. Let's go ahead and see if there's any questions. Dustin, do we have any questions in the chat from anyone?
Currently, no.
Okay, so if you have any questions, feel free to submit them or contact your financial advisor. I want to add one more note. This is all determined by your goals. So a common question that I might get, that I have gotten as I've talked with clients, is, well, should we just put everything in bonds right now? The answer is most likely no, because your goals might involve the long-term growth of stocks, or you might be on the younger end. And if you're 25 years old and you're putting away money, you need the longer-term growth of stocks. We also don't know for sure what interest rates are going to do. We could get higher interest rates. There is a possibility of that. So you never want to make big shifts of all of your money one direction or another. What we do is we take an institutional approach where we're not making big swings. We're just making little adjustments depending on what the world gives us and depending on what investment opportunities there are across the globe, and creating an allocation for you that's going to meet your long-term goals, that's going to weather the storms that it needs to weather in order to help you get what you need. So I don't want anybody coming away from this thinking I'm putting all my portfolio in bonds because of the opportunity. I think it needs to be a discussion with your financial advisor, figuring out where your risk tolerance is and if a overweight or underweight applies to you. So
We have one question.
great. Go ahead.
It says, can you talk about the balance between the dividends gained in a bond versus the drop of value of said fund?
Yes, I can. So if I hear you right, can the interest sometimes maybe offset the drop in the value of the bond if rates go up? That would be one scenario. And that scenario has actually played out a couple of times this year, where maybe we've started to buy a little bit longer term bond, but rates have still ticked up a little bit. So that's brought the value of the bond down just a little bit. I think if you were to buy a bond last year, if you had a time machine and went back and bought a bond at the beginning of 2022, and you bought a 10-year government bond that was paying 1.5, and then by the end of the year, they were closer to 3 or 4, that would be a lot more painful move. And the 1.5% interest would have a real hard time covering the fact that your bond value went down. For perspective on that, bonds on average during 2022 went down 12%. That's one of the biggest moves in 50 years for bonds. That's a tough year for bonds. Contrast that with stocks, going down 12% can happen at any time. That's almost normal for stocks. But for bonds, that's a big move. So I think at this point, with where interest rates are, if we get a 1% move up, it would maybe affect a little bit the longer the term, but now you're getting higher interest. So it has a greater chance, depending on how long that bond is, of covering the negative from your bond going down. So at this point, it's a little bit easier, but if you're at a time machine and went back in January of last year, it would be a lot harder. It'd be a lot harder. Good question. Any other questions, Dustin?
No more questions currently.
Okay. Well, thank you all for joining us. We look forward to having you next month. We appreciate this time we get to spend with you and talk a little bit deeper on some of these topics. If you have any questions, don't hesitate to reach out, and we'll see you next month.